Hello.
Hello.
And welcome to this quarterly video of TSP Funds. The first quarter of the year was a volatile period for markets, and despite the turmoil in the banking sector, the large majority of assets performed well, the only exception being commodities and the US dollar. Over the quarter, developed equities were up 7.7%, followed by Asian markets with 4.3%, supported by Chinese equity rebound. However, Thai Set Index started the year on a negative foot, losing 2.7%. On currencies, the dollar has been extremely volatile over the period, impacted by evolving expectations on the Fed monetary policy. As of the end of March, Thai baht finally appreciated by 1.3% against the green bill. On global fixed income, interest rate volatility has also been very high during the quarter, but the flight to safety and less aggressive central banks after the new banking turmoil finally benefited to bond markets. Overall, global bonds recorded a positive quarterly performance of 2.9%, while global credit ended slightly higher with a 3% return. It's a different story in Thailand, where bond markets were penalized by higher medium-term rates on the back of continued rate hike from Bank of Thailand. Government bond index was flat. However, corporate bonds were more resilient.
During this first quarter, TSP funds continued their rebound. The strong performance of foreign investments largely compensated the poor or negative returns of Thai assets. In relative terms, TSP portfolios ended behind their benchmark. The underweight exposure to global equities and the allocation to underperforming US value stocks have been the main detractors. On the positive side, the strong return of the two Asian funds managed by Schroeder contributed to the relative performance. Finally, in fixed income, the key contributor was the allocation to US bonds through Fidelity US dollar bond and Pictet USD government bonds.
Against this uncertain backdrop, we identify four key global themes. First, the central bank's choice: price stability versus financial stability. Recent turmoil has awakened fears over financial stability risk, with new areas of vulnerability emerging after this rapid hiking cycle. Central banks are now facing the challenge of addressing the persisting inflation while ensuring financial stability. Secondly, the persistency of stagflationary pressure, lower energy prices, and a fast reopening in China led global growth outlook to improve. However, recent developments, and in particular in the banking sectors, put the economic path at risk with downside revision on growth at a time when inflation remains sticky across developed markets. Third themes, China reopening. We revise up our 2023 growth forecast as recent economic data confirms that recovery is on track. Consumption is set to lead this recovery, and housing market is now more likely to deliver upside surprises with a solid rebound in sales. And finally, the emerging markets in the context of a US dollar stabilization. On the macroeconomic side, growth differential between emerging and developed countries should increase looking forward. In addition, moving into the second half of the year, we expect a weaker dollar, which should benefit to emerging markets. With the collapse of Silicon Valley Bank, followed by Credit Suisse rescue, March brought a wake-up call to markets. Recession risk, deteriorating earnings outlook, and contagion concerns contributed to this market stress, as well as rising uncertainty around geopolitical tension. This evolving environment calls for a defensive stance on equities. So we are increasingly cautious on developed markets, and especially in the US, where margins are under pressure and valuations are not attractive, given growth deterioration looking forward. On the opposite, we are more constructive on broad Asia and especially in China, where recent data confirms that recovery is on track. Overall, at a time of slowing growth, we continue to favor funds holding a combination of quality and value companies with robust business models that can navigate better in this environment. On fixed income, we have a balanced allocation between global and local bonds. We are close to neutrality on global duration while keeping an active management, and we continue to favor US bonds, which should gain from the flight to safety due to higher recession risk and financial stability concerns. On the credit side, we remain moderately positioned and continue to favor investment-grade signatures.
During the first quarter, we maintained a defensive positioning overall, but we remain active to adjust portfolio strategy. Within developed equities, in January, we decided to lower our exposure to Japan by selling Pictet Equity Japanese opportunities. We reinvested on Eleva European selection on the back of better economic data than expected. In the US, the deterioration of the economic outlook, falling companies' margins, and expensive valuations led us to reduce our US equity allocation. To this objective, we decided to trim Neuberger Berman US large cap value and FCH JP Morgan US equity focus. During the banking turmoil, we decided to sell Goldman Sachs Global Small Cap Core. The fund could be penalized by its exposure to smaller banks, and overall, small caps could suffer from tighter financial conditions looking forward. On the opposite, in China, where outlook has significantly improved after the country fast reopening, we increased our exposure by investing on JP Morgan China and Schroeder China opportunities. On the fixed income pocket, we tactically trimmed Pictet USD government bond after the sharp fall of US rates mid-March on the back of recession fears and expectations of a less aggressive Federal Reserve. However, we aim to keep an active management on global bonds allocation given the high volatility of interest rates. At the end of the quarter, we also started to turn more constructive on Thai bonds. Therefore, we increased our exposure to K fixed income and Krung Sri active fixed income. Finally, we decided to sell our diversification on PIMCO commodity real return. Commodities, and especially oil prices, could remain under pressure in a context of weaker demand in developed countries. Within the commodity space, gold benefited from its safe haven status, but has potential to pull back in the near term. To conclude, while we remain cautious at this stage, we will continue to have an active approach in TSP portfolio management, and we will be ready to seize investment opportunities across all asset classes. Please always keep in mind the mid to long-term horizon of an investment on financial markets. TSP Funds allows you to diversify your savings and gain access to the best experts. These are the key drivers for long-term performance. We thank you for your support and attention, and we will meet you again in July for the next quarterly video of TSP Portfolios.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น